Hello everyone and welcome to our latest economic update. As we record this on the eve of the US election, which will be closing shortly, and certainly the last quarter has kind of paled into insignificance as all eyes are on the US and the circus that's going on over there. And whilst this election appears to be like no other, markets have continued to perform very strongly over the last quarter and continue to do so as signs of what people are calling a Trump trade, where both equities and bond yields are starting to rise, is a little strange, but quite reflective, I think, of the reality that we live in at the moment. But historical trends typically show that elections don't tend to have a huge impact on the long-term performance of investment markets. Things tend to settle down pretty quickly thereafter. But as we know, and what's important to remember, is that markets really don't like uncertainty. So the longer that a protracted, drawn-out battle or contesting election results takes to occur, I think the more volatility we can expect to see. The start of the quarter and certainly the start of the fourth quarter results, as I said, started to show that developed markets certainly were continuing to display resilience. There were signs of emerging risks in certain regions and asset classes, but by and large, a pretty good quarter and certainly a very strong 12 months that we've seen. July, however, started with a lot of market jitters as the US employment data came out, showing signs of softness. That saw the US Japanese yen carry trade unwind very quickly, and the US equity markets sell off to the tune of about 8.5%, almost overnight. And since then, global equities have continued to rebound and back to hitting almost record highs. And that resilience in the US continues to date, with GDP numbers expected to be around 2.5% for 2024. But what we still see is this concentration risk in markets, and particularly out of the US, around the mega cap stocks, big large tech companies, and anything to do with AI that we've spoken about for a number of quarters now. But that still remains, and that broadening out of the economic recovery just hasn't seemed to eventuate quite yet, but markets still are still showing resilience, and that soft landing narrative is very much looking like it's still in the cards. Domestically, we've seen the concentration risk as well continue around the thematic and the tailwinds that have supported the Goodman Group and their results over the last 12 months. And that now sees that Goodman Group representing nearly 38% of the index, which is fantastic to have largely participated in that, but again highlights that concentration risk in markets. Pleasingly, bonds have had one of their best quarters since 2000. Interest rate sensitive assets, alongside that, like I said, around real estate and infrastructure, have also seen strong gains, which is great for clients and portfolios, helped by stronger equity and bond prices as well. In the US, the bond markets have normalised for the first time in over 2 years, suggesting investor optimism around avoiding that recession and inflation being under control and economic stabilisation, buoyed by the 50 basis point rate cut by the US Fed. But with both parties in the US promising big spending policies, this is an area that we're watching closely, and as I alluded to before, as part of that Trump trade, we're already seeing bond yields rise again in the US. So it's a wait and see in that regard. China has finally come to the party and put some stimulus into to try and support their ongoing slowdown, trying to stabilise the market and inducing a series of programs which we've outlined further in our economic update that follows this video. GDP GDP growth rather continues to be soft at around 4%, influenced by global trade challenges and restricted domestic demand. Equally, it'd be interesting to see what happens if Trump gets in and his proposed up to 60% tariffs on China and their export market as well. In terms of investment outlook and sector caution, as I mentioned earlier, there's a lot of concentration risk that still remains around large cap and tech and AI stocks at present. We've seen large daily sell-offs where earnings results don't quite meet expectations. And although share prices continue to recover pretty quickly, it appears to be largely driven by this continued multiple expansion or sentiment, which, as history tells us, can only last so long. So there are and continues to be a lot of unknowns at the moment. We'll know more, I think, in the coming days when the US election and their global policies markets are able to digest that. But that's it for now. And if you have any questions, please feel free to get in touch. Otherwise, stay well and we'll speak to you again shortly. Thank you very much.